Hello everyone, this is Patrick from AllQuant. Now, back in August last year, I presented this chart which shows the overlay between CPI or inflation and the Fed funds rate. Back then, there was a wide gap between CPI and the Fed funds rate, and I said that the Fed funds would need to rise quickly in order to catch up with CPI. That is exactly what happened, but thankfully, CPI also came down, which helped to close the gap faster. Now, today, the gap has been closed. This is a good thing. So this means that inflation may be coming under control now. Market is always forward-looking, and this is why when the market sense that inflation is coming under control, the major asset classes all began to recover their losses from last year. Gold did the best, helped by the weakening US dollar. At the same time, the correlation between stocks and bonds reverted back to the usual negative correlation. The natural hedging qualities of bonds against equity market risk is now back. So going forward, we can expect bonds to cushion equity market losses. Likewise, the correlation between stocks and gold also reverted to the negative territory. This means that the safe haven qualities of gold is also reinstated. So the failure of multi-asset diversification that we've seen last year is now safely behind us. CPI has been on a steady path down since the middle of last year. Based on the Cleveland Fed's nowcast, CPI is expected to continue to trend down in the near future. However, this is headline inflation, which includes energy and food. Commodity prices are on a downtrend, so this is driving CPI down. But what about core inflation, which actually strips out energy and food? This is a chart that shows both the headline and core CPI. We can see that core CPI is stickier. It is not coming down as fast as the headline CPI. Even the Fed's nowcast for the next CPI release shows core coming down slowly. Now, core CPI is staying high because businesses have been able to pass on high prices to consumers because there is strong demand from the consumers. And this strong demand is underpinned by a strong labor market. This is also the primary concern of the Fed, not that because the Fed wants people to lose jobs, but a strong labor market could actually keep inflation high for a longer time to come. Okay, and once inflation expectation sets in, this is going to be a very unhealthy dynamics for the economy going forward. All right. Now, this single chart here shows how resilient the labor market has been. Even throughout last year, in the midst of the worst inflation crisis seen in 40 years, the unemployment rate stayed at a historical low levels. Workers remained gainfully employed, and so they were able to cope with high prices. So the big question mark is, how unbreakable is the labor market? These next three charts may help to provide some clues. The first chart on top shows the unemployment claims filed by people who lost their jobs. This number has been rising recently, indicating that job losses are climbing. This would not be a big issue if unemployed workers can find another job easily. This is the case when job openings are high. However, looking at the middle chart, open positions are declining at the same time that more people are losing their jobs. So if this trend continues, we can expect the unemployment rate to increase. Finally, the last chart at the bottom shows the personal savings rate in the US. It is clear that people stored up plenty of savings during the pandemic with nowhere to spend their money. However, when restrictions were removed post-pandemic, revenge spending quickly hollowed out people's pockets. The savings rate has now dropped back to historical low levels. This means that consumers may soon balk at the high prices they have to pay. And so businesses may be forced to cut prices if they still want to move their inventories. When that happens, core inflation should drop quickly. Market participants seem to agree with this and are therefore pricing in a declining Fed funds rate going forward. The question on everyone's mind is, does this automatically mean that a recession is on the way? Personally, I think that some form of recession should happen. The only question is, how bad is it going to be? And that would depend on how high the unemployment rate is going to rise. If the labor market can soften just enough to bring down core inflation, this would be the perfect soft landing scenario that the Fed is trying to engineer. Now, how likely are we to achieve this perfect balance? Only time can tell. In the meantime, markets seem to assign a decent probability of a soft landing as we have transitioned into a low volatility regime. We can position ourselves for this soft landing scenario, but we have to watch carefully for complacency to set in. This is what we continue to do over at AllQuant. All right, so that's all I have for you in terms of this market update. Until the next time, stay safe everyone.